Hey everyone, this is Sam Does Stocks here, and today I'm going to be going through market news and other just general events that have been happening that I find quite interesting. So, of course, elephant in the room today, Nvidia earnings. Now, if we look at Nvidia earnings right now, I've already checked it, so this isn't going to be like a live reaction, but the stock itself is down quite a bit after hours. I want to say it's down around 6%, if I remember correctly. Yeah, 6%. So, admittedly, I don't think a lot of Nvidia investors were expecting that, right? Because for such a long time frame, especially when this AI boom really started to pick up, Nvidia investors have been seeing 10 to 15% 10 to 15% gains after earnings, and that's just not happening anymore. Now, do I think that this is a overreaction? Yes, and I actually would argue that it's a bad reaction. In my opinion, the stock should be up. Because if you look at it, I mean, Nvidia stock, it trades at a 4 PE of, I want to say, around 50. Now, yeah, 42. That's not bad at all once you consider their growth factors. I mean, their growth factors are incredible. I mean, I'm just reading that headline right now. 122% growth. That's insane. You're not going to find that in any other large cap stock. You could look at Google, you could look at you could look at Meta, you could look at Amazon. Like, I own Meta. It's my largest position in my personal portfolio. But am I going to get the same results with Meta as I am with Nvidia from a growth perspective? Absolutely not. It's just not going to happen. So, reading through it now, I mean, 122% growth, incredible. You've got net income more than doubling, incredible. And I mean, this is billions of dollars just falling to the bottom line. So if I was an investor in Nvidia, look, would I be buying at this point? Yes. I think with a high quality stock like Nvidia, a dip like this is either going to not last that long, or if it does, it's not going to go down much further. So I really do think that Nvidia would be a buy. I think the one thing that your large cap investors are looking at, like your big hedge funds and others, multi-billion dollar market players, they're trying to time when the slowdown of Nvidia will happen. Because if you look at Nvidia historically, this company goes through huge boom and bust cycles, right? I mean, 2018, boom, minus close to 40% from to 2019. 2021 to 2022, no surprise, along with the rest of the tech sector, it just got crushed, minus 60%. You look at other time frames in the market, and Nvidia just lags behind in a lot of ways. But now that they're really, tapping into this niche of AI, now that they've really found their way, I mean, Nvidia is going to continue to crush it. There's no doubt in my mind about that. And on that note, another stock that I personally own, I don't own Nvidia by the way, but I would consider buying it at this price point, is CrowdStrike stock. CrowdStrike stock, in my opinion, is look on paper, right? Your average investor who looks at PEs and basic metrics is going to freak out when they look at the metrics of this company because on paper, a PE ratio of 496 just sounds ludicrous. But when it comes to investing, I would argue the only PE ratio that matters is the forward PE. So if we look at CrowdStrike's forward PE, I want to say it's around 50, which again, that's still expensive. Okay, it's a 68. That's definitely expensive, but if you factor in the growth that CrowdStrike gets, it's not that expensive. It's really not. I mean, we can look at the consensus here. I want to say they grew their revenue, yeah, 32%. That's incredible. And my bullish thesis on CrowdStrike has always been that as the Internet of Things continues to expand, there's going to need to be a wider security net to protect it. And quite honestly, yeah, there's quite a few players in the cybersecurity industry, but they don't have the same product suites that CrowdStrike has. CrowdStrike has multiple platforms that tailor to multiple things cybersecurity related. And when you put them in a package for a large company, that's an extremely attractive offering. And look, that outage that they had will affect them, but it's not going to affect them forever. I think this giant drop that CrowdStrike had, I want to say it was close to 50%. Yeah, close to a 50% drop from peak to trough. I think that was an overreaction because if you're a long term investor, sure, the reputation of CrowdStrike is damaged in the short term. But in the long term, their products are incredibly sticky. Their reputation is going to recover. And guess what? their bottom line is going to continue to grow. I mean, let's look at CrowdStrike's net income. I believe they're just becoming profitable, which when you're in that stage as a company, damn, that's attractive. I mean, look at that. They were running net losses, and again, when I see a chart like this, I automatically think to myself that that was because of investments that they were making, and now they're starting to flip a profit. And you can see we're in the early stages of growth, but that is the best time to own a company, in my opinion. If you can own a company in the early stages of growth and you can time it right, which I believe that CrowdStrike is in the perfect timing category as a buy right now, you can make a lot of money and you can have a stock that people are going to want to buy from you and envy. And that's the truth. I mean, let's look at CrowdStrike's, net, revenue growth as well. I mean, we just read it, 32% year over year. Let's see how it's doing, as a whole. So it looks like, I mean, look at that. That is a beautiful upward chart. Beautiful upward chart. And the truth is, it's gonna keep going up. It's just gonna keep going up. And paradoxically, like you can see that those growth rates right at the bottom, those green bars, they get smaller and smaller, which on paper looks bad, but then you realize that the amount of revenue that they're bringing in each quarter is actually bigger than the starting point. All of a sudden, it doesn't matter. Look, CrowdStrike is one of those stocks where, at the end of the day, if you own it, you are going to make a lot of money in the future. That's my personal opinion. It's not financial advice, but again, I think as this Internet of Things continues to expand, CrowdStrike is going to be the play. The only, I guess, worry that I would have is Amazon getting into the cybersecurity space because of, their AWS offering. But I don't know if that'll happen. And quite honestly, if it does, then yeah, I would consider selling CrowdStrike because Amazon has the capex resources to combat any growth that CrowdStrike could have. But still a great company, though, in my opinion. Now let's check out what's going on with the market in general. I'm sure it's going to be all Nvidia this, Nvidia that, but I want to see if anything, you know, catches my eye. Look at that. Berkshire Hathaway hit $1 trillion. Now, Berkshire Hathaway is one of those companies that it's a classic, right? You own it, you make a great return, and you'll continue to make a great return. The one thing I would caution an investor with when it comes to buying Berkshire Hathaway, and Warren Buffett really struck a cautious tone in his most recent investor letter, which made me question buying the stock, was when you have as much money as a Berkshire Hathaway does, right? I think they're rolling in $200 billion, just something ludicrous. The amount of money that you can put into stocks becomes more limited in the sense that if I put $5 billion into stock, that's going to move the needle in a big way. There's only a handful of stocks where, like Warren Buffett could put 10, 20, $30 million and not worry about moving the needle. But those stocks are so combed over that a lot of them don't represent a good value. The only one, or I guess the only two that I could really see Warren Buffett buying comfortably with a margin of safety are Meta and Google. And out of those two, I feel like Google would make more sense because let's be real, Meta is probably out of Warren Buffett's, sphere of knowledge, right? There's too many product sets with that. The whole Oculus thing would probably throw him off from a capex standpoint. If I was Warren Buffett, and I'm running out of investment ideas, which he is, because there's not a lot you can put that money towards without really moving the needle. Google would be my go-to. But it's incredible. I mean, the fact that it hit $1 trillion, he's now in the $1 trillion club, that's incredible. I'm sure Buffett's sitting at home right now looking at his investment portfolio and smiling. I have zero doubts about that. And it's interesting too. It looks like they're raising the price target on Berkshire, which I'm not surprised by that in any sense. I mean, they've got a lot of cash on hand, right? And I mean, look at the growth on that thing. It just continues to go up. And the thing with these stocks, folks, is I think most people would look at a stock like this and they would see that return and they would say to themselves that that return cannot be replicated. And in a way, they're probably right, but you can still get phenomenal returns. I mean, I said it in my last video where I talked about Meta, but when I was talking about Meta, you have to look at something like Meta, which Meta is up about 50% year to date, I want to say, maybe a little less after today. Yeah, about 50%. Most people would look at that and they would say to themselves, okay, Meta has no more room for growth this year. I'm not going to buy it. Or, okay, Meta has had a great year-to-date return. It's not going to have that same year-to-date return in future years, which even if it doesn't, the stock is still cheap and the stock will still probably go up a significant degree because winners continue to be winners and losers continue to be losers. That's why if you're buying like a falling knife, right? Like we can look at a Lululemon, for example. Lululemon, in my opinion, is a classic falling knife. You can look at the stock and most people would go, oh, wow, minus 50% year to date, 20 PE, reputable company. Why don't I buy it? The reason you probably wouldn't want to buy it is because it could go that much lower. I learned that the hard way a couple of years ago with Alibaba. When I bought that stock, I thought to myself, great, this is a great value stock, bright future ahead. Then all of a sudden, the fundamentals continued to deteriorate, and I had to sell my shares at a 50% loss. And that's the honest truth. I am by no means a genius investor. I am an average investor at best. So when I see a stock like Lululemon, sure, the fundamentals may look attractive, but the fact is, the fundamentals can continue to deteriorate. The market is a weighing machine, and quite frankly, in the long run, this stock has not appreciated that well for a reason because it was probably overvalued the majority of this time frame. But other than that, everything looks good with the stock market. I have no doubt that continued optimism in the stock market is the best mindset to have. As always, stocks do continue to go up in the long run. Thank you all for watching. See you in the next one.